It's 2:17 a.m. Most of the world is asleep. No headlines, no breaking news banners. And yet, somewhere in the financial system, trillions of dollars are quietly being borrowed and returned before sunrise. By morning, the economy will feel different. Not because of something you did, but because of what happened overnight. Here's the uncomfortable truth. The most important market in the global economy isn't the stock market. It isn't crypto. It isn't even bonds. It's a market most people will never hear about. A market that only exists for a few hours, and if it breaks, everything else follows. This matters right now because whenever this market starts to hiccup, central banks panic. Not publicly, quietly, behind closed doors, with emergency tools and very fast phone calls. If you've ever wondered why interest rates suddenly jump, why banks freeze lending, or why the phrase liquidity crisis shows up out of nowhere, this is where it starts. Let's rewind. Imagine you're a massive bank, not a normal bank, a balance sheet so big it needs its own zip code. Every day, money flows in and out of you non-stop. Deposits come in, payments go out, trades settle, loans clear. At the end of the day, the math must work. Regulators demand it. Markets expect it. No excuses. Sometimes you have too much cash sitting around doing nothing. Sometimes you're a little short, not broke, just short for the night. So you borrow. Not for years, not for months, for hours. You borrow money overnight. You promise to return it tomorrow morning, and you put something valuable on the table as collateral, usually government bonds. This is the overnight market. At first glance, it sounds boring, almost polite. Can I borrow some cash until morning? Sure, here's a treasury bond. See you at 9 a.m. But this is where the system reveals its personality. Because this market isn't about profit, it's about survival. Every major financial institution depends on it. Banks, broker-dealers, hedge funds, money market funds, even governments indirectly. Every single night, they line up, some with extra cash, some desperate for it, and they make deals measured in basis points, tiny numbers, big consequences. The interest rate on these overnight loans doesn't just reflect supply and demand, it reflects trust. Trust that the collateral is good. Trust that the borrower will exist tomorrow morning. Trust that the plumbing of the financial system isn't clogged. Most of the time, it works so smoothly no one notices. That's the goal. Invisible, boring, stable. But when it doesn't, things get strange fast. Let's make this concrete. Say a bank ends the day short $10 billion. That sounds catastrophic. It's not. It's routine. They hand over $10 billion worth of government bonds and borrow the cash overnight. Tomorrow, they reverse the trade. Cash goes back, bonds come home. Everyone sleeps well. Now imagine that instead of borrowing at a normal rate, the price of that overnight cash suddenly spikes, not gradually, violently. One night, it costs 2%. The next night, 8%, then 10%. That's not a market signal. That's a scream. It means someone doesn't trust someone else. Or worse, they don't trust the collateral. Or worse still, they don't trust the system to unwind cleanly in the morning. This actually happened. In September 2019, overnight borrowing rates exploded out of nowhere. No recession, no pandemic, no major bank failure. Just silence, then chaos. The central bank had to step in and start lending billions every night just to keep the system from choking on itself. Most people never heard about it. Markets barely reacted. But inside finance, alarms were blaring. Because this market is the foundation, and foundations are not supposed to move. Here's the uncomfortable math. The modern financial system is built on the assumption that tomorrow will arrive on schedule, that payments will clear, that collateral will be accepted, that cash will show up when promised. Overnight lending is how institutions bridge today to tomorrow. Remove it, and suddenly no one can be sure they'll open for business in the morning.
That's why central banks obsess over it. They don't care about vibes, they care about this rate. They target it, they defend it, they intervene when it misbehaves. Because if the overnight market breaks, rate hikes don't matter. Economic forecasts don't matter. Stock prices don't matter. You're no longer managing growth, you're managing a fire. And here's the irony. This market exists because everyone is highly leveraged and highly efficient. Money is never sitting idle. Every dollar is doing something, being lent, rehypothecated, counted twice in different places. It's brilliant and fragile. So when people argue about whether the economy is strong or weak, they usually look in the wrong place. They look at GDP, unemployment, inflation. But the real question is quieter. Are institutions still willing to lend to each other overnight? Because that answer decides what kind of tomorrow we get. And the strange part is, the more advanced the system becomes, the more it depends on this tiny window of trust that resets every single night. So here's the thought to sit with. If the most important market in the world only works because everyone believes morning will arrive smoothly, what happens the night they stop believing? That question hasn't been answered yet. And that's where the story gets uncomfortable. Because the overnight market doesn't just reflect trust, it manufactures the illusion of safety. Here's what rarely gets said out loud. Most of the collateral used in overnight lending is supposed to be risk-free. Government bonds, treasury bills, the safest assets on earth. But those same assets are reused again and again and again. One bond can quietly support multiple loans across multiple institutions in the same night, not because anyone is cheating, because the system is designed that way. It's efficient, elegant, and slightly absurd. Imagine using the same house deed to convince 5 different people you're good for 5 different loans, as long as none of them ask for the house at the same time. That's not a metaphor, that's modern finance. As long as everyone believes tomorrow will arrive normally, the chain holds. Cash comes back, collateral returns. No one looks too closely. But when stress appears, people don't panic all at once. They hesitate. They lend a little less. They ask for slightly better collateral. They charge a slightly higher rate. Those slightlys compound fast. This is where hype and reality split. Publicly, we talk about interest rates as if they're set by policy speeches and press conferences, as if a committee flips a switch and the economy responds. In reality, the only honest interest rate in the system is the overnight rate when things go wrong. That's the one nobody can spin. When that rate jumps, it's not about inflation expectations, it's about fear. Fear that collateral won't be accepted. Fear that balance sheets aren't what they claim. Fear that someone, somewhere, won't be there in the morning. And here's the quiet joke. The overnight market is supposed to be boring. So boring that no one asks questions. The moment it becomes interesting, it's already a problem. That's why central banks move so fast when it cracks. They don't debate. They don't workshop language. They flood the system with cash. Not to stimulate growth, not to help households, but to stop the trust chain from snapping. Because once institutions stop lending overnight, they don't just pause, they retreat. Balance sheets shrink, risk disappears, credit dries up, and suddenly businesses that did nothing wrong can't roll payroll. Markets that looked liquid become deserts. Perfectly good assets can't be sold at any price. All because tomorrow became uncertain. This is why crises feel sudden. The stress builds quietly in plumbing no one watches. Then one night, the overnight market refuses to behave. And by the time it shows up in headlines, the damage is already baked in. What makes this moment different is scale. The system is larger, more interconnected, more optimized. There's less slack, less idle cash, less margin for error. Every improvement in efficiency has made overnight funding more essential and more fragile. Which raises a final uncomfortable contrast. We argue endlessly about the future: artificial intelligence, productivity, digital money, geopolitics. But the economy still depends on a very old ritual: borrow tonight, return it tomorrow. Trust that the sun comes up. So the question isn't whether the overnight market exists. It has to. The question is how many nights in a row it can absorb stress before trust turns into caution and caution turns into refusal. Because the day after a broken night doesn't start with panic, it starts with silence. And silence in finance is never calm.